Okay, you've probably heard the doomsday talk, inverted yield curves, recessions, the whole shebang. Maybe a lot of that came from me. So sorry about that. And look, you might be thinking, dude, none of that happened. Can we move on already? Picture this. You're loaning your friend Sarah $1,000 for a year. You're taking a risk, right? Things might happen. She might not pay you back. Plus, inflation exists in a year that $1,000 won't get her as far at the grocery store. You're going to charge interest to cover that. The longer the loan period, the higher the interest rate typically is. Think of it like those car loans. You pay more in total for a 5-year loan than a 3-year one, even if the monthly payment is smaller. Why more risk for the lender over a longer period and more time for inflation to do its thing? Forget fancy graphs and charts for a second. Think of the yield curve as a ladder where each rung represents a different loan duration. Short rungs bottom of the ladder. These are your short-term loans, like the ones that mature in a few months. Think of them like the low rungs of the ladder. Easy to reach in normal times, these have the lowest interest rates. Why less risk, less inflation worry for the lender? It's like lending your neighbor $5 for a week. You don't need much payback for that. Middle rungs, the middle ground. These are loans like a 5-year car loan or a 10-year government bond. They're those middle rungs of the ladder, reachable but require a bit more effort. More time is equal to more risk for the lender, so naturally they're going to want a slightly better interest rate. Top rungs reaching for the sky. These are your long-term commitments, your 30-year mortgage or bonds that take decades to pay back. They're like those super high rungs of the ladder loads of risk, because who knows what the world looks like in 30 years. You could get hurt climbing that high, metaphorically, for your finances, so lenders demand the highest interest rates for taking that risk. This is the normal yield curve. It slopes upwards just like the rungs of a ladder get further spaced out as you go higher. Imagine that same ladder somehow flips upside down, now climbing to those short-term loans. Those bottom rungs is suddenly the hardest, most precarious thing. That's what an inverted yield curve is signaling. Short-term is equal to scary short-term loans are carrying insanely high interest rates. That's the market basically screaming danger ahead. This could be the fear of crazy deflation making your money more valuable over time, or anticipating a frantic rate cut from the Fed. Long-term is equal to less risky. Strangely, climbing farther up that upside-down ladder seems safer. Long-term rates are lower. People are rushing to lock in better rates for the long-haul, betting that tomorrow's rates will be even worse. This flipped ladder is like walking into a room where the gravity is suddenly reversed. It breaks the fundamental rules we expect. That's why investors get spooked. It tells us the market expects things to get weird and potentially painful in the near future. Let me know if you'd like some additional real-world examples to drive this home, or if you want to explore what those Fed rate cuts actually mean for the average person. Okay, there's the textbook reason why an inverted yield curve is weird. Lenders should be compensated more for longer-term risk and inflation. But honestly, the bigger factor is what it signals about market sentiment. Deflation, bomb incoming. If everyone thinks the economy is about to hit a wall and prices will plummet, suddenly getting no interest on a short-term loan sound amazing. Your money's buying power will skyrocket. Think about waiting for sales. You delay buying that new TV if you think it'll be 50% off in a few months. Apply that mindset to the entire economy. The Fed will panic. We just gotta wait. When things start going south, the Federal Reserve's main weapon is lowering short-term rates. If everyone's pretty sure that's about to happen, they'll rush to lend short-term now while they can get a decent rate. Those long-term rates drop in turn as investors compete to lock in a higher rate before the Fed cuts it to near nothing. The freaky thing is the very expectation of trouble can actually help cause trouble. If businesses sense that everyone thinks a downturn is coming, they start acting like it. Why add more employees if you think sales are about to tank? Well, guess we can delay that equipment upgrade. If the news is all doom and gloom, folks start pinching pennies, which slows spending even more. This hesitancy feeds right back into the whole mess. Economic activity slows down, which justifies those fears about deflation and Fed intervention. The inverted curve gets even steeper, and the cycle continues. It's that psychological aspect that makes this signal so much more potent than just a math problem. Inverted yield curves don't always lead to disaster. Sometimes it's a false alarm. But the longer it lasts and the more pronounced the difference in short-term versus long-term rates, the more serious that warning should be taken. It's like your car making a weird noise for a day. You might ignore it, but if it's been clunking along for a month, it's time for a thorough checkup. Yeah, there are instances where the curve inverts and the economy just kind of shrugs it off. Those are like the car making a funny clicking sound for a few seconds. Weird, but maybe nothing to worry about. But here's the thing: when we focus on the 10-year to 3-month yield curve, it's got a perfect record of predicting recessions. 10-year, the long view lenders who commit to a 10-year loan are making a bet on the next decade. They're factoring in not just the immediate future, but longer-term trends in inflation growth, economic stability, etc. When this interest rate drops dramatically, it signals that the smart money doesn't trust things to stay good for long. 3-month, the short game. These are the super quick loans highly influenced by what the Fed's doing right now with interest rates. When this rate is spiking, it often means the market thinks the Fed's about to step in and take drastic measures, meaning the economy is already on shaky ground. Put together, this inversion means long-term investors are willing to take lower returns because they'd rather lock something in now than risk the economy cratering and rates getting cut to almost zero. Let's not just talk hypotheticals. This specific curve has a scary track record. In 2008, financial meltdown curve flipped. Then came the housing market crash, bank failures, the whole 9 yards. In 1974, inflation and recession. This was a double whammy: high inflation and economic contraction, not as severe as 2008 or the Great Depression, but still painful. In 1929, the big one. Okay, we all know what happened here. This was the mother of all recessions, the Great Depression. Look, no indicator is bulletproof, but when something's got a perfect track record and has stayed flipped for a long time, it'd be irresponsible to ignore it. This isn't just a blip on a chart. It's a sign of deep-rooted pessimism from some very powerful players in the economy. Think of it like multiple doctors giving you the same diagnosis after running a bunch of tests. Would you just blow them off? Or would you take those concerns seriously and look at ways to prepare? That's where the smart money is placing their bets on the near future. Inverted yield curves and recession talk can feel like someone constantly tapping you on the shoulder, whispering it's all going to end horribly. But here's the mindset shift I want to highlight. It's not about the end, it's about a transition. Forest fires, scary but necessary. Forest fires are terrifying events. They destroy, they displace, they seem senseless. But ecologists know that fires are a natural part of the cycle. They clear out dead growth, making way for stronger, healthier new plants to flourish. Economies sometimes function in a similar way. Recessions, as resets, recessions can be brutal. Jobs lost, businesses closed. However, they also act as a hard reset, washing out unsustainable excesses and inefficiencies. Well-run companies survive and thrive in the leaner environment that follows. The goal isn't to make you afraid, but to make you aware. Think about it this way: the clueless crowd. Most people react with panic. When the market tanks, they sell at the worst possible time, locking in their losses. They miss out on the rebounds because they're too afraid to get back in. The prepared investor, you knowing a downturn might be coming, can adjust now. You can shore up your cash reserves, shift your portfolio to less risky assets, heck, even find specific trades designed to make money when the market goes down. Bulletproof portfolio: how to allocate your investments so they weather the storm and may even grow during turbulent times. Recession-resistant stocks, companies that provide essential goods and services, tend to hold up better even when times are tight. Contrarian trades, option strategies, inverse. ETFs: there are ways to profit directly from the market's decline. These require more skill, hence the education aspect. Nobody wants to hear their town's in a tornado watch, but wouldn't you rather have that warning than be caught unawares? Recession-proofing your finances is no different. It's the workout routine that gets you in shape before the race, not during.